The BRICS alliance, consisting of Brazil, Russia, India, China, and South Africa, is making significant strides in its efforts to reduce reliance on the US dollar in global trade. In a major development, BRICS members China and Russia recently signed a trade agreement worth $260 billion, where they will use their local currencies, the Chinese yuan and Russian ruble, instead of the US dollar to settle payments for commodities traded between the two nations. This deal is not just symbolic, but represents a concerted push by BRICS countries to prioritize the use of local currencies over the dominant US dollar in order to strengthen their native economies. The BRICS bloc is also convincing other developing countries to follow suit and settle cross-border transactions in local currencies. Under the $260 billion trade agreement between China and Russia, 95% of the trade, amounting to around $247 billion, will be settled in Chinese yuan. The remaining 5%, about $13 billion, will be settled in Russian rubles and euros. As an analyst noted, this year, $260 billion worth of trade between China and Russia. No US dollar, it's mostly Chinese yuan and Russian rubles. A few euros are in there too. This shift away from the dollar is expected to be replicated among other BRICS plus member countries in the near future. The BRICS countries have been vocal about challenging what they see as the unilateral sanctions imposed by Western powers and the continued dominance of the US dollar in global trade. By conducting more trade in local currencies, BRICS aims to reduce their vulnerability to US sanctions and the volatility of the dollar. If more developing countries start conducting business in their own currencies, as the BRICS agenda advocates, it could significantly undermine the strength of the US dollar in the coming years. Analysts predict that the next decade could see local currencies gaining more power in the financial world as the dollar potentially loses its muscle. Some key US financial sectors that could take a direct hit if BRICS succeeds in ditching the dollar include banking, foreign exchange, tourism, consumer goods and production. Despite facing tough sanctions from the US and allies, Russia's oil business has remained robust. By selling oil at discounted prices to countries like China and India, who then re-export it globally, Russia has managed to keep its economy afloat. In April 2024, Russia's oil and gas revenue is projected to double to $14 billion, compared to $7 billion in the previous year. The Russian government expects to earn around 11.5 trillion rubles from oil and gas sales in 2024, a 30% increase from 2023, as it recovers from the impact of weaker prices and sanctions on its energy exports. Many countries are eagerly buying this cheaper Russian oil and paying for it in their local currencies, which benefits both Russia and the buyers' domestic economies. This has helped Russia circumvent the intended effects of Western sanctions to a significant degree. The addition of Iran to the BRICS grouping has further bolstered the bloc's energy clout. In the first quarter of 2024, Iran exported a record 1.56 million barrels of oil per day, mostly to China, earning around $35 billion annually. With Saudi Arabia, the UAE and Egypt also joining BRICS, the expanded BRICS Plus now includes several of the world's top oil producers and consumers, accounting for around 30% of global oil output. This could enable tighter cooperation between BRICS, plus members on energy matters, and allow them to have a bigger say in global oil markets. While a new common currency for BRICS was not announced at the recent summit, the group did commit to studying the feasibility of a shared currency or similar mechanism. A BRICS currency, if implemented, could facilitate easier trade between members by reducing transaction costs and exchange rate risks. More significantly, a BRICS currency would be a major challenge to the US dollar's role as the world's primary reserve currency. By enabling members to trade without using the dollar as an intermediary, it would accelerate the process of de-dollarization that the bloc is pursuing. However, creating a viable BRICS currency faces several obstacles currently. The Chinese yuan, the most used among BRICS currencies, still has limited availability outside China compared to the dollar. Other BRICS currencies suffer from problems like lack of full convertibility, Indian rupee, volatility, Brazilian real, South African rand, sanctions, Russian ruble, or being pegged to the dollar, currencies of new Gulf members. Inadequate financial infrastructure makes exchanging BRICS and other emerging market currencies more costly and riskier than using the dollar. Despite these challenges, the renewed focus on local currency usage and de-dollarization at the recent BRICS summit indicates that the bloc will continue pushing to chip away at the dollar's dominance, even if a full-fledged BRICS currency does not materialize in the near term. As one analyst put it, the BRICS countries are essentially trying to build a wall of BRICS as a counterweight to Western-led financial institutions and the dollar-based global economic order. The $260 billion local currency trade deal between China and Russia marks a significant escalation in the BRICS countries' efforts to de-dollarize their economies and global trade. By increasingly invoicing trade in their own currencies and creating alternative financial infrastructure, BRICS aims to insulate itself from Western sanctions and reduce its vulnerability to fluctuations in the US dollar's value. While challenges remain, the BRICS de-dollarization agenda appears to be gaining momentum, especially with the bloc's expansion to include more strategically important emerging economies. If successful, this could lead to a more fragmented global financial system, with the dollar no longer enjoying the same hegemony it does today. However, the path to meaningfully eroding dollar dominance will likely be a long and gradual one for BRICS. In the meantime, the US and allies will need to be alert to the implications of the bloc's growing economic clout and its potential to reshape the global financial order in the coming years. Constructive engagement and efforts to reform international institutions to give developing countries a greater voice may be necessary to maintain a cooperative global economic system. The bottom line is that the BRICS $260 billion local currency trade deal, while not an overnight game-changer, is a clear sign that the bloc is serious about challenging the dollar's global supremacy and ushering in a more multipolar world order. How this tussle between the dollar and its would-be rivals plays out will be one of the crucial stories shaping the 21st century global economy. Based on the provided search results, here is a comprehensive analysis of the impact of de-dollarization on the USA, the role of BRICS, and China's trade in the context of the ongoing shift away from dollar dominance. The de-dollarization trend, which refers to countries moving away from reliance on the US dollar for international transactions, is accelerating and reshaping the global financial order. This is driven by several factors, including the weaponization of the dollar through sanctions, global economic imbalances, and the desire of emerging economies to reduce their vulnerability to US monetary policy. The waning influence of the dollar could have significant consequences for the US economy. Reduced demand for US assets may lead to higher borrowing costs and inflationary pressures, loss of the exorbitant privilege that allows the US to finance trade deficits cheaply, diminished effectiveness of sanctions as a foreign policy tool, potential loss of competitiveness for US exports due to a weaker dollar. However, a more balanced global financial system could also benefit the US by mitigating imbalances and the costs associated with being the issuer of the dominant reserve currency. The expanded BRICS group, which now includes major commodity exporters like Saudi Arabia and Iran, is at the forefront of the de-dollarization movement. BRICS countries are exploring alternatives to the dollar, such as using local currencies for trade and creating new financial infrastructure. Discussions are underway regarding a potential BRICS currency backed by commodities like gold. Though challenges remain, the BRICS bloc accounts for a growing share of global GDP and aims to create a more multipolar economic order. While a BRICS currency may not replace the dollar outright, it could chip away at its dominance and create a more fragmented international monetary system. As the largest economy within BRICS, China is playing a key role in the de-dollarization process. China is promoting the use of the yuan for trade and investment, particularly through the Belt and Road Initiative. An increasing share of China's trade with Russia and other countries is being conducted in local currencies rather than the dollar. China is also exploring digital currency initiatives like the digital yuan and M-Bridge project to facilitate cross-border transactions. However, the yuan still faces challenges in becoming a major global currency due to factors like capital controls and geopolitical tensions with the US. In conclusion, while the US dollar remains the dominant global currency, the de-dollarization trend led by BRICS and China's growing economic clout is likely to result in a more multipolar financial system over time. The US will need to adapt to this new reality while working to maintain the benefits of dollar primacy. The pace and extent of de-dollarization will depend on the interplay of economic and geopolitical factors in the coming years. How do you think the $260 billion trade agreement between China and Russia, using their local currencies, will impact global economic dynamics? Let us know your thoughts in the comment section below. Do you want to watch more videos like this one? If yes, please like and share the video and subscribe to get exclusive videos about how phenomenally China is developing and growing its influence over the world. Until the next video, stay tuned.